On this episode 14, May 2019, we're going to be talking about some monthly real estate stats, leading economic indicators, other real estate news, discussion on debt, and talk about ways to save money on taxes.
In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
How you doing, Dean?
Good as always, Lane. How about yourself?
Good times. I'll talk about that a little bit, but let's get into the legal stuff and serious stuff. You guys can read that on your own at your own free time. Nice thing about a video is you guys can put pause. But why don't you take us away, Dean? You're the resident, the ex CPA who likes to find people houses to buy and sell.
Always. So yeah, starting off with the Oahu real estate statistics for March. Seems like it's another month for the buyer, in other words, the buyers are getting a little bit more leverage now. And what I mean by that is if we're looking at the median single family prices and the median condo prices, it's kind of a mixed bag for the price wise. At 782,500 for median single prices, we see a little uptick at 3%, which isn't much, and a downtick on the median condo prices, going down 1% at 429. Yeah, but
this number seems really big, right?
Yeah, so that's where we see when I'm saying it's a win for the buyers is in the closed sales going down and the days on market going up again. And so you just look at the arrows, right? So like you said, the days on market going up to 24 days for single family compared to same time last year, going up 71%. That's pretty darn high. The interesting thing is look at the single family prices that didn't change it, and that leads us to the next slide. I went to hear a presentation done by DBED a few weeks ago. That's the Department of Business, Economic Development and Tourism. And so the chief economist was talking to a bunch of realtors, and I'm a finance major too. So I had some econ friends that used to geek out over going to the presentations by the chief economists of the various big corporations. I think back then, I think Paul Brubaker, Leroy Laney for First Hawaiian Bank and Banco back then. We used to geek out going to these presentations and hearing about these things. But one thing that this Mr. Tien talked about from DBED was leading indicators. And one leading indicator specifically were annual sales volume and tracking that. So as we see, this is Oahu single family sales and median prices, sales at the top versus the prices at the bottom. So we're seeing the trend, right? So on the top, we see single family sales peaking in the last cycle in 2004. That was a peak at 4,749 in terms of volume. And then when you go down below, we look to find out where the peak is in terms of the prices. And we see it 3 years later in 2007 at 645,000 was the peak last cycle. So that was a 3 years lag in terms of when we see the sales peak versus when we see the prices peak. So, economists, finance people like to look at historical, as well as a lot of everyone else does. But now we're looking in the current cycle, and we see a peak in 2017 for single family sales. You see the peak, yeah, and it's dropping in 18. So kind of makes you think, okay, well, if it's similar to the last cycle, then at the peak in 17, then if it's giving us a 3-year leading indicator, then that takes us to 2020. So,
or it could be like 1993 to 1994, right? So nobody has a crystal ball.
Right. So that's the fun thing about economists, right? You go back. I mean, it's anything, even for stock market or even history in general. Everyone is looking back at past trends to tell the future, because to your point, Lane, nobody has crystal ball. So
Yeah.
what's the best thing to do? Look what happened before and try to see if we can learn from that, or take any takeaways in terms of trends. So next slide, same thing. They took the same information from condo prices, sales as well as prices, and we see the exact same thing, peak in 2004 with the sales volume, and then the condo price peak 3 years later. And similarly, in this current cycle, we have a peak in 2017. So what lies ahead, I'm not too sure.
Yeah, I mean, one thing that I'm kind of like keying in on here, like, not to necessarily mean like sales doesn't really correlate with listings, right? Because right now, plenty of stuff is kind of coming on the market, which ideally makes the prices cool down a little bit, right? If there's more options.
Yeah, as like you said, if inventory starts building up, then that theoretically that has a reverse correlation to the price, right?
Yeah, or it could not be correlated at all, right? Like you could have a lot of sales, but if there's a whole glutton of inventory that comes on, well, that doesn't.
Right. And that's the whole lead lag thing, right? Because until those inventory goes down, then you know what I mean? So yeah, it creates, that's why I guess we like to look at the leading and lagging to see, okay, what's causing what now.
Yeah.
So another interesting thing that they talked about was sorry, I didn't change the title, but it was comparing Hawaii versus the Hawaii economies versus the U.S. economies. And so in that first middle block, they're saying that we, meaning Hawaii, missed out on the IT boom that the rest of the U.S. had benefited. And so it's a different,
never changed over. Yeah,
different economic structure, right? So with that said, but if you look at this other 2011 to current, it's kind of a little bit more consistent with each other in terms of when you're looking at Hawaii GDP versus US. So I guess you could look at it different ways. One way you could look at it is that, investing in Hawaii, it's a different market. We've always said that, right? It's a different market than the rest of the US. So it could offer a diversification into the rest of your portfolio. Say if you're doing stocks, bonds, or even real estate investing in the mainland. Yeah, we're a different place. So to all the people in the mainland that said, yeah, Hawaii is a different, not even part of the United States, or they live in their little grass shacks. Maybe it's statistics like this that kind of feed that. Yeah, or we don't follow the same the trends like the rest of the United States.
Yeah, and there's kind of that leg thing going on too. Yeah.
Right. Yeah. So yeah, so good times listening to the DBED talk, and enjoy hearing what they have to say. Everything is up to interpretation, right? And it's kind of gotta do what you want to do for your own personal benefit, and everything is different based on what your either risk tolerances are and what your existing portfolio looks like, and where you're trying to go and what's your end game.
Yeah, I'm gonna check something real quick out. It's
Yeah.
take too long, but I think the yesterday, like the GDP stuff came out. They said it was like 3.9 for the quarter.
Huh.
So it shocked everybody. They were expecting 2.
Lower, right? Yeah, right.
But they came out 3.9.
Wow, that's exciting times.
Yeah.
Hopefully, still no interest rate hikes.
No, yeah, they're not gonna raise rates, I think, but it's kind of interesting. But so you guys can check out my mainland investing website, Simple Passive Cash Flow, and if you guys listen to podcasts, you guys can check it out on Spotify, iTunes, Google Play, iHeartRadio. And if you guys want to check out my book, text 587-317-6099. Text ebook to that number, and you'll get a free e-copy of that book. But here it is, Dean. I finally followed your lead and quit my job too. We no longer get these ribbons anymore.
Congratulations, Lane.
Yeah. I don't know how many ribbons you got of the gone to a meeting that should have been done with an email. But if you want some of those, I've got a few of those left. propping up the desk. So some random collection. Here's that on the bottom right. That's that article that I found today. GDP came out 3.2%, well ahead of the consensus of 2.3. So I don't know. You know, everybody was. I think the last couple of videos were talking about the 2 and 10 year inversing, right? Now it's like supposedly the beginning of the doom and gloom, but here's some different news. I think it's no secret that the economy was like kind of slowing down since 2016. But hey, here's a nice spike here, and you know, here's another article down there from the street that came out talking about the impact on certain individual stocks. So it's good times, and you know, people are kind of bullish and they're investing in kind of crazy things. So I was in Forbes. I talked about how I don't really like hotel investing because it's still a speculative asset class. They do well in good markets, but they do horrible in bad ones. You know, I remember in 2009, me and my buddy were like the only ones in Las Vegas gambling. Nobody was there. No one had any money. Oh yeah, and you're talking about the interest rates. We had an inverted yield curve, which academics call an indicator of recession. The Fed, after raising rates in September and again in December, announced it envisions no rate hikes in 2019. Some summary of the market. So some of the bigger cities on the mainland are starting to see big home sale declines. I think we've talked about San Francisco for being one of them, but also Seattle and looks like California, Vegas. Remember, you know, primary residence are, I think, where people speculate the most. You know, you and I both invest for cash flow and more B and C class properties, the more blue collared areas. So we don't really see this kind of spikes, but you know, you're seeing those prices start to come down a little bit.
Yeah. Oh, Salt Lake number real big.
Yeah,
Surprising.
big. I know you got some Las Vegas stuff. Maybe this will finally make you sell it.
Don't go there, Lane. Don't go there.
Yeah. So here is I do apartment investing. So I follow apartment data, which sort of mimics or is a good indicator for single family home rentals too, but it's a lot more numbers driven, a lot more data, as opposed to single family homes are a lot more fragmented. But you know, if you kind of look, each market is different. But you know, if you're just taking all the national averages here, I think the thing to look at is we're very stabilized here. I mean, things are keep moving up across the board. You know, rents are still going up 3% on average. Of course, you know, certain ones are gonna be higher than others. Here's Honolulu, which is, yeah, you know, like average effective rent is $17.87, where the average in America is $12.61. So definitely winning that battle there.
Oh, look at Charleston, West Virginia, 14.6. Anyway, sorry, go ahead.
Yeah, I mean, there's a lot of these places are a lot cheaper. I mean, a lot of the apartments I have are like 500, 550 a month. Oh, so this is, you and I talk about all the time how people are very debt averse, which I get, but I finally got my article published in Forbes debunking that. So now I can die a happy man.
That was on your bucket list.
Yeah, this was on my bucket list.
We gotta see how many people you touch. That's the important part, right?
Yeah. So you guys can read that at simplepassivecashflow.com/debt, or you can find it in the treasure trove of Forbes articles where they go to die. But there it is.
The anti-Dave Ramsey.
Yeah. So I'm sure if you guys are more interested in that, and it definitely is a little red pill for people, but I'm sure Dean would love to have lunch with you and talk all about that. Where I would point you to my podcast where you can listen over it again and again. So this one is a kind of interesting. It's not really real estate focused, but it's more just break down income. And I tell people all the time, you know, when I moved from Seattle a few years back home to Hawaii, you know, everyone says, yeah, the cost of living is so high. I'm like, well, not really. I mean, the houses are no different than Seattle or California, but I mean, I took like a 20-30% pay cut when I came back home for the same job, engineering job. So I think this sort of shows, the percentiles of lower income, middle income, and upper income. Here's Hawaii at the top. I think this one kind of shows a little better. What they're doing here is they're representing the middle income area. We're definitely in that front pack here. Alaska is always, that's just a bunch of dudes going up there for oil and industry like that. It's kind of an outlier. Whereas, these are a lot more of the affordable places. I mean,
So the bigger spread is where the bifurcation of the middle of the haves and the have-nots. Is that how do you?
Yeah. I mean, you look at Hawaii. I mean, it's big on the haves and have-nots. I mean, you got the guys in Kaka'ako, all this stuff. They're breaking down all those cool bars at Ala Moana they used to have. Yeah.
I know, right?
No more. Not gonna have any of those kind of places. Just gonna have big high rises now for all the foreign people to live. And but yeah, like I got an apartment in Mississippi, Alabama, Oklahoma. You got stuff in Missouri.
Yeah.
I mean, it's all these more blue collar states is where the real cash flow investing is.
Ooh, I like this.
Okay, so you joined in one of my projects here, and you're kind of asking about, all right, how does the taxes happen, right? Like on bigger deals, whether you have like a single family home or a 500 unit apartment complex, you can depreciate the property.
Right.
In single family home, you can depreciate in 27 years the home part of it, not the land part. But on bigger properties, you can do what's called a cost segregation. And if you guys are more interested in that, go to simplepassivecashflow.com/cost seg, SEG, and read more about that. But, in here, I invested in deal, put in 35 grand, and I got 27 grand back in first year paper losses with bonus depreciation. Here's another one. This one isn't that great, but, here's another 35,000, 27 loss on this one. So,
and now you get to take full advantage of that.
Yeah. So now that's why we quit our jobs, right? Because now we can actually take this off active income, where before it just kind of went in a bucket.
But please consult with your personal CPA.
Yeah. So, this next one, you and I were talking, went over both our heads, right? This one came out by the IRS. If you guys own rental property and kind of doing, your tax planning, this is something to read. But it's talking about, when the new tax laws came out in 2017, they made all these changes, but there was no real like case law or precedent set. So the IRS finally came back a couple of years later and made this really confusing 3-slide thing here to explain it and create a safe harbor. So like they're like, well, if you do these things, you're cool. I don't know what your thoughts, Dean, are, but like mine's are like, hey, just read this and sort of understand it, but at least be able to quiz your CPA to make sure they're doing.
I asked my CPA about my tax CPA specifically about the deals, like the syndications, and it was in the heat of tax season, so I got now that I recall, I think last month I got a couple links, and she said, "Here, read through these and let me know if it counts for you." I'm like, okay. So
yeah, sounds like you need a new CPA.
I can't get rid of this one.
I guess I could. Okay. This is the one you can't fire. Right?
I mean, technically I could, but it'll be the most expensive. Ever.
So I mean that's I think as an investor, you need to know a little bit about it, but you don't need to
For
be an
sure.
expert. But you need to know, because a lot of times you'll get one of these terrible CPAs. I mean, it's just like engineers. Most engineers kind of suck, and like that's you go to like I don't want to say it, but like the neighborhood CPA who does their taxes, they don't have a clue on ways to save taxes. They'll tell you something like, oh, and put your money in your 401k, which in my opinion is a horrible way of saving taxes. Oh yeah, we closed. This is that property that you and I joined forces on, 309 units
Mm.
in El Paso, right on the
Yeah.
border, just in time for Cinco de Mayo.
Oh, we're going out for drinks then, to celebrate?
Yeah, I heard that the margarita was created here.
Oh, really?
Yeah, yeah.
Hmm.
Believe it or not, I believe it. So yeah, we will probably be going out for drinks. I don't know if we're gonna have the next REI Aloha meeting at Pi or Beer Lab. Actually, I like Pi better.
Oh, yeah.
Pi's a little nicer. Free parking too, or not free parking, but $3. If you guys don't have $3, I'll give you $3. But yeah, they have this like really cool smoky drink, and they put it in like a smoke orb.
They add the smoke to it, the
Yeah,
flavor.
they add the smoke to the thing.
Huh. Is it like mixed drinks?
Yeah,
Oh,
yeah.
interesting.
So it's pretty good. One guy got it, and then the other guys had to follow suit too. But yeah, this is probably going to be on the third Thursday of the month. So that'll probably be the May 16th, I believe. But yeah, check out rialoha.com for our meeting schedule there. But yeah, we had the breakfast club a couple of weeks ago at Zippy's with other out-of-state investors. But
Yeah.
anything you else got on your radar there, Dean, that you're working on?
No, nothing on top of mind. But I did go to your breakfast club, and I got to say that was fun. Um, Met a lot of active investors, so that was cool. I know a lot of times you go to these various meetups, and you either get a sales pitch, or you get newbies. I mean, we have newbies too, but no, everyone is just wanting to meet like-minded people and share their experiences and things like that is what I've experienced. So I like that breakfast club. I had fun.
Yeah, no jerks are allowed. If not, we take them out of there.
Blackball them.
Yeah, yeah. You get what you pay for with us, and these things are free, so
Right.
you get us. All right, guys. Well, yeah, share the YouTube channel links with your guys' friends, and we'll see you guys next month.
See ya.
Bye. Hey guys, it's episode 13 of the Real Estate Braddahs. Today we're going to be talking about monthly real estate stats. What season is it? Tax time, and talk a little bit, is the recession coming? Here's the legal disclaimer and legal notice. You guys can read that in your free time. But I want to introduce Dean Ueda here. You guys can reach him at deanueda@gmail.com. Are you still going to keep that CPA tag?
Yeah, I can probably take it off. I have that asterisk because I'm not in public practice. So the Hawaii Society of CPAs, if I'm gonna put that designation, I have to make it clear that I'm not practicing. So I'm certified, but I'm not in public practice. That's the disclaimer, I guess you
So
could
it's
say.
not like a professional engineering, like a PE, where if I let mine's lapse, I can't even put it anymore. I can't put the
So we
star.
can still put it, but we just have to make sure that we let people know that we're currently not in
Oh,
practice. Like if you look me up at DCC, I am in good standing, but I don't have my permit to practice.
oh.
In good standing means that I pay my dues, smaller dues, and I'm keeping up with this minimum CE for to make sure I'm navigating the grade properly.
Oh, yeah. For us, it's just we didn't make any bridges that fell down. So what? Some more fun stuff. What's happening
Yeah.
in Hawaii real estate lately?
So interesting times again. I mean, we're seeing this is for February median prices compared to February 2018, but we see a slight increase for both median single family and condo prices. They went up 2% at 789,000 for single family and 415 at the condos and townhouses. However, contrary to those, the prices going up, we see closed sales going down and days on market going up, showing um, strengthening power for the buyers now, because now, there's less things closing and things are staying on longer. So it's giving the buyers a lot more um, power, I guess, and which we've been seeing for months now. And at the same time, we're seeing listings, the inventory building up, right, at 42% for single family and 31% for um, condos. But it's just so interesting because even though the closed sales and days on market is showing, strengthening for the buyer side, we still have the prices creeping up year over year on prices. So it's kind of interesting times, but all in all, it's still a great time for it's getting better for the buyers is basically it. And especially with the rates staying low and actually going a little lower, that it's a good time for buyers now too. So that's something good. One thing I wanted to talk about is we're talking about shifts and corrections and trying to put things in perspective. So I was going back historically, looking over the median prices historically on Oahu, identifying two of the corrections. One being the one started in 1994 with the Japan bubble bursting, and that was actually it took us 9 years to recover. And when you look at the peak 1994 compared to the trough around 1999, it was like a 21% decline, right? And a 9 years to recover to get back up to the median price. And then the subprime crisis and started more in 2008, but the peak was in 2007. That one lasted 6 years when you're just looking at when median prices came back up to the original peak. And so that was a 6 years to recover, but that was only a 11% decline when you're looking at the peak compared to the trough, right? So, I mean, perspective, keeping things in mind is that if you're an owner occupant, timing is a little bit harder, and writing out something like this is not as bad because you're living in the home and you're paying down your principal and you're building up your equity, right? So it not as affected to the owner occupants. I guess in terms of equity, if you want to tap into it, but it might be a different consideration if you're an investor, right? Trying to get back up, especially if you're investing and you have a lot of times people investing in Hawaii, you're trying to retain legacy wealth and you're trying to go for the appreciation because it's not really a cash flow play. But just wanted to look at that, take it into consideration, and it's a total different market than stocks. But to me, the decrease wasn't nearly as bad as the stock market. However, the recovery period was also different.
Yeah, and this is the Hawaii one, which is a pretty tame chart. I mean,
Yeah, right. And you compare it to like Las Vegas or Atlanta or Detroit.
Yeah, I think that was last month's one, right? I had the slide with what Florida, Las Vegas, and Arizona, those plummeted, right? In the
Super big hits. Yeah, super big hits. So to your point too, yeah, Lane, exactly. It's a lot more tame than how other parts of the country took it. Yeah. And so again, talking about putting things in perspective, and if as an owner occupant, a lot of times you can't really time the market as much. But one thing that is good is I pulled this off of the mortgagenewsdaily.com, and seems like the 30-year fixed rate mortgage is at its 52-week low at 4%, 4.03. So I mean, we're at lows again in terms of your 30-year mortgages. So good. And again, that's another sign. In my mind, it's like a good time for buyers too, right? Because especially owner occupants, you're not timing it as much as investor can, and you also can. Investors have different ways. You can choose different regions that you want to invest in, or different types of investments too. So good time. This is the point of this slide. Okay. I've been getting a lot of calls from people, what season it's tax season. So, my wife being a tax CPA, she's ramping up for 415, and now is the time to gather. For some people, it's their time to gather their documents and their support, put together their tax binders to provide to their CPAs, or bust out buy their TurboTax from Costco, or some people are even trying to find CPAs right now, believe it or not. And it's challenging, but trying to help people out how they can. But I guess my point is, this is also a good time for investors like us, Lane, is take a look at our portfolio, real estate portfolio. All of our rent rolls and our 2018 statements are coming in, so we can calculate our return on our equity. Get CMAs done. Find out what the market rate is, and so you can find out how much equity you have in your investments, and that way you can properly calculate what kind of return you're getting on this equity, and you can determine, can I use, maybe there's other alternatives to use my equity and put it in better types of investments. It's kind of similar to how on an annual basis your financial advisor calls you and says, okay, let's talk about your stock portfolio. Is it time to rebalance? Try to look at what kind of how it changed over the year, and how things get unbalanced in terms of market prices for different stock or bond portions of your portfolio. So I guess my point is, now is also a good time, besides doing your taxes, to take a look at your real estate portfolio and see if you want to start paring things down. Considering all things considered, especially we always talk about the corrections. Now might be a time to see if you want to make changes. Yeah.
Or maybe if you like the home you're going to live in, maybe now's the time to go lock up another 30-year debt and pull some money out.
Or get a, or get a HELOC if you don't have one now, right? Something like that.
Which is
tap into that equity.
Which is makes people gasp in Hawaii, right?
But you and I have our own opinions on that, right, Lane?
Yeah. I mean, my your parents, if they're still working, now's the time to go and get that 30-year debt before they lose their W-2 income and they can't qualify for anymore.
Yep, exactly.
Security is not an equity in your home. That so if you guys are interested in more real estate investing, check out my podcast, Simple Passive Cashflow, and simplepassivecashflow.com. Dean is starting to come out to the real estate club meetups here. You can check that out at reialoha.com. And if you want a free e-version of my book, go and text ebook to 587-317-6099. Just some random news here. I don't know if you caught this one, but Oregon okayed the first statewide U.S. mandatory rent control law. So you got rent control now in Oregon. And I don't get political here, but typically the people that kind of know what's happening money wise, you'll see these rent controls typically hurting the people that it made to protect. But I think this one is actually a pretty good idea. People will read a headline and have a thought, but if you dug into this, if you read on their left side, they cannot increase the rent increases more than 7% in 1 year. I think it's pretty fair.
That's very fair. I mean, it sounds like it makes me wonder something must have been happening for them to implement something.
They were like pushing rents up like 10-20% on people. So you've got rents for like $1,000, it would go up like 120 next year.
Okay, so
That's
this is
not right.
different.
Yeah, that's not right.
Yeah, because
So
I've heard other stories on the other side from the landlord side. They say like in California where there is rent control, and the landlord hasn't been able to raise rents for like 5 years or stuff. So this is like sounds like more like protection, yeah, for the tenant.
right.
Yeah, yeah.
And it's just a good lesson. Like you always gotta read into this stuff a little bit. Because I had it on my Facebook group, and I put it up there, and obviously the comments are always like, oh, rent control sucks, right? Like, well, you guys even read this article? Like, 7% is what it said.
Yeah, that
So
sounds fair.
gonna get into a little bit more doom and gloom here. Something I've been kind of learning about recently is this. There's if you go online, you can search this 10-year Treasury yield, and this U.S. 3-month Treasury yield just inverted. A few days ago, actually, and academics will call this an indicator of a recession. And also take notice that the Fed raised rates back in September, and December recently they announced that it envisions no rate hikes in 2019. So we've kind of talked about this in previous webinars, but the Fed raising rates is their ability to build up some dry powder in case there's some trouble ahead. So if the economy slows down, they can decrease the rates and kind of infuse cash into the system. Got this kind of showed in a different way. Got the 3-month in green there. So March 22nd was like the day that this pivotal moment happened. This is a phenomenon called yield curve inversion, and kind of wrote it down here. The blurb, my blurb on it. So the regular folks like us never really feel this, but this affects the bank's ability to pay by paying retail to CD savings of 1% using short-term interest rates like the 3-month or the 2-year yield. The regular people like us walking into the bank, they'll give us that 4 to 5% commercial real estate loan that we've been getting on these syndications, or you guys get that 3.5-4% loan on your primary residence backed by Fannie Mae, Freddie Mac. There's that difference there. The arbitrage is how the bank makes money.
Right. Yep.
So the short-term yield is higher than the 10-year Treasury yield, which is a little ass backwards. Then the banks can't really make money, right? So if the banks stop making money, they'll stop lending, and when the banks stop lending, everybody goes, no, I don't know. I mean,
Yeah. Well, the spread's gonna be so low that they're gonna, like how in the past what they had to do is they started bumping up all these ticky-tack fees here and there, and so people start complaining, what is this fee for? Because now that, like you said, they can't make off the spread, so they got to make it off of something else. So then it might be fees.
oh,
Yeah.
I didn't know that. When
Yeah.
was that? When did that happen? Is it like the checking account fees and stuff like that?
Yeah, so that like, yeah, exactly. And after subprime and like you said, the Fed rate dropped to bottom. So like you said, that spread, that arbitrage becomes so low that banks have a hard time. They're not making the money off that spread, so they have to find alternative ways. So then you see these fees popping up that weren't there before.
Yeah.
Yeah.
So from the economy's perspective, companies start getting a little gun shy themselves, and that kind of starts the falling forward mechanism where everybody freaks each other out. Yeah. And the equity markets is all based on emotion. So that's sort of the beginning of a recession. But the question is, is it going to be, the soft landing type, or is it going to be the hard landing type, like how we had last time?
Yeah.
A lot of things I read, I read this, like, it's a paid subscription, ITR Economics, super smart guys, but they're predicting a more soft landing, and they've got several indicators that they look at. And yeah, I don't know, what are your thoughts? You think we're going to see another 2008 or? .com thing again?
No, I mean, barring any other, hard external catastrophe, like you said, I see it more of the soft landing because of I'm thinking how U.S. fiscal policy, they're going to try to manage that rate, and even monetary policy. I mean, I don't. I mean, like you said, not to get political, but they just passed that. What are they doing? The money's billions of dollars for the wall, right?
Oh, really?
Yeah. So then
I thought that was a joke.
okay, that could be, but if that thing gets passed, and then we have all these dollars going back into the economy for the infrastructure, and that kind of helps in the short term, the economy from that standpoint, right?
Right. And Trump is generally pro-business, so he usually is bullish for the economy.
Right.
But yeah, he's kind of known for the helicopter money. And when I mean helicopter money, they, usually when the government infuses cash into the system, they give it to the banks like Citibank, JP Morgan, that kind of stuff, which is messed up because it never really leaves them.
Right.
So the idea is get a helicopter, take it over all these like corporations and put it right to the people.
Right.
The best way is shovel-ready projects such as a wall, I guess.
Yeah. No. Yeah. Exactly. You pour it back into the infrastructure, and that's how it hits the economy directly. Versus, like, I think when after subprime crisis, like you said, they tried to pour it back into the financial system, but the banks still didn't want to loan out. So then that was the problem, right? The funding which was supposed to be given out was still dry. So financing was impossible still. So it didn't help us, That was a challenge.
Right. So I'll show some more graphs on this next month, but I don't think it's anything to really be worried about. I mean, if you're investing for cash flow or you're buying a primary residence, I think it's still the time to do it. But if you guys sitting on a lot of equity and you don't want to live there forever, I'd say give Dean a call and sell that sucker quick. Now's the time to do it.
Or figure out ways to tap into the equity. If not, right? I mean, it's all based on situation, but that's a good point.
Yeah, but yeah, don't take my word or Dean words for it. Come out to our meetings, arialoha.com. We had one at Pi the other month. The next one is probably going to be April 18th.
Ooh, after tax season. Sounds good.
Yeah. So that'll be the Breakfast Club one where we go out on Saturday morning. And it's more of an out-of-state investor focus for that one.
Sounds fun.
But any other projects there, Dean, that you got working on, or any other parting words?
Other projects? No, just looking into syndications, as you know, Lane. So I'm excited to see what my first endeavor is into syndications. I don't want to go too much into detail at this point, but yeah, that's my way of getting into a new industry, and hopefully, if and when there's a correction, we'll be able to ride it out.
Yeah, I hope so too. All right. Well, yeah, you guys can check us out at raloha.com or check out my website, simplepassivecashflow.com, or contact Dean if you want to buy or sell something, and we'll talk to you guys next time. Bye.
See ya.
Hey, just some legal stuff here. Although these two brothers are pretty knowledgeable and have over 2,100 rental units and own over $160 million worth of real estate, the preceding are only ideas and not to be taken as legal, tax, or financial advice, okay? You should always seek the professional advice of other professionals on your team and think for yourself and do your own due diligence, okay?
We just two local guys with so much to say, so listen to the real estate brothers today.